Yo guys, it's John here with Option Lab. In this one, I'm going to show you guys how I made a little over 3K in just 4 clicks. The strategy is about 80% probability. It's not always that high. Usually I'm trading around a delta that's about 0.3 or 70% probability. It's an option strategy, and I'm going to show you guys exactly how I did it. Super passive, super easy. I literally did 4 clicks, sat back, and chilled while this money came in. So if you guys are interested in more trades like this, click down below. There's a free Discord. I drop all the sauce in there. Anyway, let's get into this. Okay, so first question you guys are probably asking is what strategy am I using? So I'm an options trader for the most part. So let's go through the method here. So the method is finding high IV stocks that either have recent news, upcoming earnings, or a large recent move in either direction. So the latter part of that sentence kind of causes the first, right? So high IV stocks, if we're an option premium seller, meaning we're selling to open options, so naked puts or credit spreads, all the strategies I trade that are high probability, the best times to do it is when IV is high. The premiums are high, so if we're selling to open, we're receiving more money to open the trade. The strategy I usually use is playing the correction, right? So let's say, for example, recently Target dropped huge on earnings. I wrote naked puts below where it already dropped to, expecting that there would be a correction after earnings. I collect premium for selling those puts, and then the stock, in theory, should bounce back and I make money. So high IV, news, or earnings report upcoming, those are usually the times that naked puts or these spreads, credit spreads, are a good method. So let's go through the trade. So the trade was on DJT. Obviously, the election was looming, so DJT was extremely volatile, and inherently, it's really not that valuable of a company. So it's also cheap. So the premiums were really high for the cost of the stock, and I could go really far out of the money and still get a high premium for selling naked calls or naked puts. Now, you don't always have to do that. You could sell spreads, which I use for a lot of the people I teach this method to. They use it on smaller accounts, and you could do that too. I'll show you how. But in this case, I sold naked calls and naked puts. So let's go through what that actually entails, because I'm sure a lot of you are coming from futures or some other nonsense. Anyway, you can see here, these are the 4 trades I took that added up to that 3K. I sold to open the naked calls, the 60 strike. Here I did the 80 calls, sold to open, then the 72 and a halves, and then the puts. So all of these options right here, so all of these options were under a 0.2 delta. So what does that mean? The market is literally telling me, based on the delta of these contracts, that there's an 80% chance that these options expire out of the money. So if we look on a chart, what does that actually look like? So here's these options on the chart, and here's the DJT chart right here. And I outlined, I put a line where each of these options is, right? So I sold to open the 60 calls, collected a premium for doing so. Sold the 72 and a half calls, got a premium for doing so. 80 calls, same thing. And the criteria for making money is I keep that premium no matter what for entering the trade, and all it has to do is stay below my strike price to make money. So for the 60 call, as long as the stock by expiration stays below 60, I collect that full premium. And same here, so 72 and a halves. And the beauty is, rather than trading, if you were buying options on this stock, right? If you were going here and saying you were buying options, you have to be right about the time and the time frame in which that upward move happens and the magnitude of that upward move. Whereas this, I just have to say, okay, all it has to do is stay below this by expiration and I collect my premium. Same thing on the put side. I sold to open naked puts, and the only criteria for collecting that premium is that by expiration, this stock has to stay anywhere above 20, right? So really what this is like a straddle. It's a short straddle, right? Because I have naked calls open and naked puts open. So if you look at this, the range for profit is literally massive, right? That's why, and each of these options at the time of entry was below a 0.2 delta. So 80% likelihood it doesn't cross over 60, and at the time, 80% likelihood that it didn't go below 20. So what better way to tie up your money and make literally a quick 3K off almost no margin, where you're tying up little money to enter the trade and it's 80%. So super good. Anyway, let's go into here and I'll show you guys what this looks like on the chain. So this is the DJT option chain, and you could see how am I seeing the probability of that move or the magnitude of that move occurring. So if I sold to open the 22.5 puts, I collect, say, $125 for doing so if we split that in the middle, and there's only a 13% chance that it actually drops below 13. So to open these puts, I sell to open, I collect my premium right off the bat, and there's an 87% chance that that move doesn't happen, and I can just write them again. And that's what I do every single week in my Discord. So if you guys want to join, like I said, I post these plays all the time. It's totally free to join. All right, so let's go back up here, and I'm going to show you guys kind of like the profit range of, like I said, the profit range was huge, right? So if this stock stayed anywhere between 20 and 60, all these options expire worthless. I don't get assigned any shares, long or short, and I keep all that premium. So beautiful trade. Again, join my Discord. It's free. Okay, so what is the general strategy? This is called the wheel strategy, and it goes like this. You guys can, look this up yourself, or I have more material on this, but basically you sell an out of the money cash secured put to open, sell to open, not buy to open. If the stock stays above your strike by expiration, the put option expires worthless and you keep the premium. If it drops below, so if we have a stock, it goes like this, and you have a put, this is your put, and then the stock drops below your put, you're assigned 100 shares per contract at the strike price, but you keep the premium. So no matter what, for selling to open a naked put, you keep the premium. The beautiful thing is, if it drops below, you get 100 shares theoretically at a low price, and you keep the premium. Now, let's say you do get the shares. So in this case, if it doesn't go below, you just redo this, right? So you do it again. In the case of this, you're assigned shares. Now you can do this on the other side. So now you have, say, 100 shares, and you could sell to open a naked call, a covered call now because you own shares. And if the stock stays at or below, you keep that call premium, and you could write another round of calls. And if it goes above the covered call strike, you lose the 100 shares of stock. Now you kept the premium from the put, the premium from the call, you sold the stock, and now you're right back at the beginning. Super great method, high probability, and if you're trading this on stocks you know and trust, you are golden. So the alternative strategy is what's called spreads, and I just sat on about an hour one-on-one call with somebody explaining this, and it's honestly mind-blowing for people who haven't traded these strategies before because they're super high probability. In this case, if we have a smaller account and we don't have enough to buy 100 shares of stock, if that naked put gets assigned, we can sell the naked put. In this case, actually, it wouldn't be naked. So we're selling a put and then buying a put at the strike price or a few strikes below it. And that creates a limited risk, limited reward trade with a profit chart that looks something like this, right? So basically, this is the put, our put strike price. This is the price of the stock on this axis. As long as this stock stays anywhere above that naked put leg, we keep the premium, right? So it's actually easier to see on here. So if we enter this trade as it's entered as one vertical credit spread, and as long as the stock by expiration stays anywhere above our the -1 put leg, we keep the premium, right? And even if it goes all the way below, this leg protects us from having to get assigned shares, and then it's limited risk, limited reward. So if you guys want more information on that, like I said, I'll post more videos. I have a bunch in the Discord. Join up and try to make this quick, understandable. If you have any questions, Just leave a comment below or DM me or message me on Discord. Anyway, peace.